Hello, everyone. Let's start with a little knowledge quiz. Take a second now and read the three statements A, B, and C, and then match the correct answer to the correct statements. Your answer choices are 3%, 8%, and 70%. Let me read the statements while you consider your answers. A, the percent of Americans over 65 who will need long-term care. 3%, 8%, or 70%. B, the percent of Americans who think it'll be very likely they will need long-term care at some point in time in their lives. 3%, 8%, or 70%. And finally, the percent of Americans who have long-term care insurance. 3%, 8%, or 70%. Okay, let's see how we did. The percent of Americans over 65 who will need long-term care. The answer to that one was 7%. The percent of Americans who think it is very likely they will need long-term care at some point in time in their lives. The answer to that one is 8. The percent of Americans who have long-term care insurance. The answer to that one is only 3. Welcome to my presentation. What 70% of retirees don't know about long-term care and why that matters. My name is Tim Gardner, and I'm a wealth manager and founder of Chatham Wealth Management. Thank you for coming to learn more about long-term care planning for retirement. I want to assure you that after this presentation, you'll be much better informed about how people plan to pay for their long-term care when needed. Now, you may be wondering, why is Tim giving a presentation about long-term care planning? I deliver presentations on various financial education topics such as Social Security, retirement planning, tax planning, and IRA planning. My goal is to inform and educate my audience so you can understand how critical financial planning topics affect you and your family. I'm making this presentation because many of my client families confront the challenge of long-term care. Some have done a much better job than others in planning for it. My goal is to encourage you and your family to make a plan now. We all want financial security in retirement, and when we can address how we'll pay for long-term care, we're more likely to enjoy our retirement and be optimistic about the future. This presentation is organized into 4 keys. Each key builds on the previous one to form a solution to our presentation problem. I've prepared some notes to help you remember what I cover. You can find a link to it in the description section. It's a PDF with a page called Finally Getting Long-Term Care Planning Right. It's an overview of what we'll discuss today, and you can refer back to it as needed. I also want to mention that I'll invite you to a long-term care planning overview meeting at the end of this presentation. I offer this no-charge one-on-one meeting to privately discuss the issues raised in our presentation. I'll tell you more about it a little later. Also, I want to assure you that this is not a sales presentation. You will hear nothing remotely close to a sales pitch. Let's proceed with starting by asking why planning for long-term care is essential and what problems it solves. The problem is that long-term care remains a confusing and unaddressed challenge to many people's financial security when planning for a safe and secure retirement. While many people understand that some retirees may need long-term care, planning for it is often overlooked. There are many reasons why people put off planning for long-term care. They include some of the following. It seems remote and too far off. Many people think they already have a sound financial plan, but it may not address long-term care. It's a stressful subject that people just don't want to talk about it. A belief that Medicare and or Medicaid will pay for it. A misconception that people need to pay for care or that their family will take care of them. A belief that it's too expensive and out of their reach. Potentially pay for it out of their pocket. And a belief that long-term care won't be needed. The costs and risk associated with not planning for long-term care extend to your family and include emotional and financial issues. Lack of planning can result in family strife about responsibilities and care arrangements. It's not uncommon for some family members to shoulder a vast responsibility for overseeing, even giving the care to a loved one. When not planned, trouble often ensues. The making of late-in-life decisions for loved ones where cost and quality of care are important can be stressful and difficult on your family. Many of us are familiar with the phrase sandwich generation, caring for an elderly family member. This is the daunting half of that equation. On the financial side, lack of long-term care planning can also extract costs, such as lost wages if they cannot pay for the care or rely on someone else to provide it. Haphazard planning approach to paying for long-term care can result in different and unintended tax consequences. The costs and risks associated with not planning for long-term care extend to your family, including emotional and financial issues. On the emotional side, Lack of planning may result in family strife about responsibilities and care arrangements. It's not uncommon for some family members to shoulder the vast responsibility for overseeing and even giving care to a loved one. When not planned, trouble often ensues. Making late in life decisions for loved ones where cost and quality of care are important can be stressful. Many of us are aware of the phrase sandwich generation. Caring for an elderly family member is just the daunting half of that equation. On the financial side, lack of long-term care planning can extract its own costs, including lost wages. A haphazard planning for paying for long-term care can result in unintended tax consequences for money you want to leave to your heirs. Your retirement and estate plans, like helping to pay for a grandchild's college education, may never come to pass if you have to use all of your savings to pay for long-term care. A plan could protect those goals. Imagine an 85-year-old woman trying to take care of her 87-year-old husband. It's really not a pretty picture, is it? You can imagine some of you are saying to yourselves, whatever happens, I just don't want to be in a nursing home, if at all possible. That's a pretty familiar feeling. And that brings us to our first key point. Long-term care isn't about an older person just sitting alone in a nursing home. It's a range of services designed to help people with health and personal care needs. The National Institute of Aging defines long-term care as a variety of services designed to meet a person's health and personal care needs so they can live as independently and safely as possible when they can no longer perform certain daily activities. These everyday activities are often referred to as the 6 basic activities of daily living, or ADLs, and they include bathing, the ability to clean oneself and performing grooming activities like shaving or brushing your teeth, dressing, the ability to get dressed by oneself without struggling with zippers or buttons, eating, the ability to feed oneself, transferring, being able to walk or move oneself from a bed to a wheelchair and back again, toileting, the ability to get on and off the toilet, continence, the ability to control one's bladder and bowel functions. Additionally, care could be entirely hands-on with a care recipient, depends on the caregiver, or as simple as standby care to provide some assistance. Who will need long-term care? There's a widely held belief that long-term care planning isn't necessary because it's too far off and likely won't be needed. Remember our questions from the long-term care knowledge quiz? Question A asks the percentage of Americans over 65 who will need long-term care. Question B asks the percentage of Americans who think it's very likely that they will need long-term care at some point in their lives. Only 8% think that they'll need long-term care, but that's wildly off the mark. As of 2021, someone turning 65 has almost a 70% chance of needing some kind of long-term care service or support in their remaining years. Of that 70%, 10 to 15% need care for at least 3 years. Additionally, the number of people with Alzheimer's dementia is rapidly increasing. Between 20 and 2030, the total number of people living with Alzheimer's is projected to increase by 35%, and the projected number of new Alzheimer's cases is expected to increase by 10% between 2010 and 2050. Long-term care is provided in many settings, including at-home, community-based, and other live-in options, from independent living to assisted living, with add-on care to full-time nursing. Often, as is the case with Alzheimer's and other degenerative diseases, full-time skilled nursing long-term care is provided in many settings, including at-home, community-based, and other live-in options, from independent living to assisted living, with add-on care to full-time nursing care. As is often the case with Alzheimer's and other degenerative diseases, full-time skilled nursing care may follow a much longer period of long-term care provided in other settings. Let's take a deeper look at these options. While being cared for at one's home, reclining years is one of the most common ways long-term care is provided. Relying on extended family and friends is really no longer the only option. As we know, relying on loved ones for your long-term care needs is fraught both financially and emotionally. While being cared for at one's home in your declining years is one of the most common ways long-term care is provided, relying on extended family and friends is no longer the only option. Relying on loved ones for your long-term care needs is fraught with both financial and emotional challenges. Fortunately, one can receive many services at home, provided these services can accommodate various levels of need. They include part-time and full-time home health aides, who attend to daily living needs and household chores. and visiting nurses and doctors who can provide medical care. Other support services like Meals on Wheels, which can provide food and other services, necessary medical equipment that can be used at home, and case managers to help monitor the needs of the person receiving home-based care. While care in one's home is sometimes called community-based care, programs outside one's home can supplement the care received. Depending upon the state, these adult daycare centers may be licensed or not, depending upon their services. Some may provide just social activities and interactions, while others may provide health services. In addition, they can provide respite care to an in-home caregiver, whether it's a loved one or a hired professional. As the name indicates, those living in independent living settings can primarily live independently. This term often refers to housing units or townhomes connected to a continuing care retirement community. Or within a standalone, there are options to step up to more robust care like assisted living, which we'll discuss next. Often, seniors can stay within independent living in a CCRC or retirement community longer than they may have stayed in their own home by adding limited support, like help with taking medications or some personal care. In retirement communities, this additional support is often called Dependent Living Plus. In a RC, if the resident's needs progress or become more extensive, a move to assisted living may be necessary. Assisted living is an example of something in the middle. In assisted living, the resident may need help with daily medications, dressing, and grooming, but can still perform some activities independently. If one's need for help exceeds that, stepping up to assisted living is the next likely step. Assisted living communities provide personalized care in a residential setting. They usually allow residents to bring their own furniture and provide social opportunities to become a part of a community. While those in assisted living settings need more care than those in independent living ones, they do not need the full-time skilled nursing care provided in a nursing home. Additionally, assisted living communities often offer their residents options for meals, laundry, housekeeping, and even transportation. As one might imagine, the cost for this kind of care can be significant. Medical costs in general keep rising, especially for retirees as their health care needs increase. In 2020, the average 65-year-old couple would need about $300 in today's dollars for medical expenses in retirement, excluding long-term care costs. For individuals, the number is $157, $57,000 for women and $143,000 for men. This is up 30% from 10 years ago. As you might imagine, the cost for all this care can be significant. Medical costs in general keep rising, especially for retirees, as their health care needs increase. In 2021, the average 65-year-old couple would need approximately $300 in today's dollars for medical expenses in retirement, excluding long-term care. For individuals, the number is $150,000 for women and $143,000 for men. That's up 30% from just 10 years ago. Of course, as those are median national numbers, there are many places where the costs are far higher. For example, in New York City, the median monthly cost for assisted living is about $5,900 a month. A private room in a skilled nursing facility costs almost $13,000 a month. So half the options in the New York area cost even more than this. Like other healthcare costs, long-term care costs continue to rise faster than the general rise in the cost of living. You may be thinking, won't Medicare or Medicaid cover this? My needs are serious? That thought brings us to our second key to understand why long-term care planning is critical. Key 2, counting on Medicare or Medicaid is not a plan most people want to rely on for long-term care, and many people aren't even eligible anyway. Medicaid to pay for the rising costs of long-term care. It is worth noting that some states are currently studying how to reform their long-term care programs. And one, state of Washington, has launched a state-run long-term care insurance program, but it's still in its very early stages. Many people incorrectly believe that Medicare will cover their long-term care costs. As good as Medicare is, long-term care is not covered by Medicare, which only covers short-term rehabilitative care that is less than 90 days. The critical word here is rehabilitative. For Medicare to pay for any services, the medical opinion has to be that the patient will recover and live a fully independent life again. Additionally, Medicare covers you for rehabilitative services It's essential to understand that Medicare only pays for certain short-term services like skilled nursing and therapy, such as speech therapy or physical therapy. But it does not pay for custodial care, the kinds of help with daily living activities long-term care assists with. It also pays nothing for senior independent living or assisted living costs. Now, Medicaid is not Medicare. It is a state and federally funded means-tested poverty assistance program that may cover eligible individuals' long-term care needs. Many low-income Americans use Medicaid to pay for long-term care. Medicaid pays for long-term care services that Medicare does not. This is all you know about Medicaid. You're in for some very unpleasant surprises. The key surprise is that you must use almost all of your assets to pay for your care before qualifying for Medicaid benefits. The Medicaid applicant can only have $2 in assets. Your non-Medicaid spouse may keep some limited assets, but amounts vary from state to state. Income is also severely limited for a Medicaid recipient, with most states capping income around 100 to 200% of the federal poverty level. To give you an idea of what this looks like, a single person can make no more than $16,300 per year or $1,300 a month in California. While some income and asset protections exist for the healthy spouse of a Medicaid qualified long-term care recipient, these protections are not unlimited. Even if you have exhausted many of your assets as you approach the need for long-term care and your income is low, what's known as the look-back period may disqualify you from enrolling in Medicaid. Usually covering the 5 years before your Medicaid application, the look-back period seeks to establish if you have transferred any assets to others. If assets are transferred during the look-back period, you will be disqualified from Medicaid even though you no longer have the assets at the time of application. Even if you qualify for Medicaid, you may still be in for a rude awakening. There is a significant shortage of Medicaid beds within all long-term care living facilities. Not every room or bed in a facility will qualify for Medicaid payments. Long wait lists for Medicaid beds can exist even with lower occupancy rates. Sometimes people do not initially qualify for Medicaid when they first enter long-term care. As they spend their assets to pay for their housing and care, they become qualified. While this may sound like an okay option, there's yet one more big surprise. The room you have been living in may not be one designated as a Medicaid. You can be forced to move from the room you've been occupying to a less desirable Medicaid room when Medicaid starts paying for your care. The shortage of waitlist rooms and the issue of being forced to move to a different room will become even more significant as baby boomers age. By 2030, all boomers will be 60 or older, making 1 out of every 5 U.S. residents of retirement age. Since Medicare doesn't pay and Medicaid requires you to use up your assets without another plan, these are very high costs and must come out of your pocket. Since Medicare doesn't pay and Medicaid requires you to use up your assets, these high costs must come out of your pocket, even if your retirement planning considers future non-long-term care medical expenses, which can be significant. You can see how long-term care expenses can significantly affect your planned annual income numbers. Not planning for long-term care is costly and risky. At this point, you probably get it. At this point, it might be prudent to do some planning and not rely on Medicare or Medicaid. You may be thinking, I've heard over the years that long-term care insurance isn't a good deal. So what are my other options? This brings us to my third key. Given the historic problems with long-term care insurance, it's understandable people have avoided making a plan. Long-term care insurance is only one way to pay for long-term care. It's possible you may have had a loved one purchase a first-generation long-term care insurance policy and had some bad experiences with these original long-term care insurance policies. This insurance was first introduced in the late 70s, though it didn't catch on until the late 80s and early 90s. When this original long-term care insurance was introduced, there were 2 options for receiving care: in a nursing home, at one's home, provided by loved ones. Concepts like adult daycare and assisted living were foreign to most people. During the 80s, the options for care started to expand, as did the demand for these original long-term care insurance policies. It provided an excellent choice for one of the most common ways people paid for the costs at the time. Many insurers got into this business because it seemed reasonable. While these original long-term care insurance policies seemed like a good idea, and they were hot commodities in the 80s and 90s, they eventually became fraught with problems. One of the problems was with original underwriting. The insurers underestimated both the increases in longevity and healthcare costs. Unlike life insurance, medical insurance, or car insurance, which you buy multiple times throughout your life, long-term care insurance is something you buy once and likely hold until you need the benefits. As policyholders started making claims many years or decades after first buying these policies and having paid premiums all those years, insurance companies began to figure out their mistakes. What once seemed very lucrative was now considered a money-losing product. Some companies did make good on their claims and lost money, some did not. Policyholders ran into all kinds of issues when insurance companies tried to fix their mistakes, such as skyrocketing premiums, post-claims underwriting, charging a new premium based on the claims submitted, refusal to qualify holders for benefits if they didn't require nursing care in addition to custodial care, requiring hospitalization before covering care, and potentially policy cancellations for reasons other than non-payment of premium. Long-term care insurance has improved over the last 25 years. Regulators enacted significant reforms in 1993, 96, 2000, and 2005 to provide consumers protections. These include requirements that all new long-term care policies have the following. They provide coverage for all forms of dementia, including Alzheimer's. They cannot require hospitalization to qualify for benefits. They can't require that skilled care be needed to pay for custodial care. They cleared up language to make claims more clear. They now need to do all their underwriting up front. No post-claims underwriting. Policies can't be canceled by the insurer other than for non-payment of premium. Premium increases are now regulated. While these regulatory changes made newer long-term care policies more appealing to consumers, the changes were not retroactive. Older policies without these protections are still out there causing problems. Because of those historic challenges around long-term care, there have been a lot of changes in recent years, and there's reason to be hopeful about the long-term care challenge. This brings us to our fourth key. New approaches to planning for long-term care address people's skepticism and provide a wide range of flexible options for people at all stages of financial planning and health. They roughly fall into a few categories: improved long-term care insurance, long-term care options on life insurance and annuities, as well as other financial instruments and assets. Let's look briefly at each. Regulatory changes led to traditional long-term care insurance improvements. Traditional long-term care insurance means paying a premium for a future claim for long-term care needs. There are no benefits outside of long-term care coverage, though the details vary from policy to policy. They frequently have cost of living protections to increase the benefit over years, protecting against rising healthcare costs. The next category of approaches for planning for long-term care are products with long-term care benefits. The most well-known of these are life insurance policies with long-term care benefit options, but they also include annuities with similar long-term care features. These policies are sometimes referred to as hybrids, as they provide benefits of life insurance or annuity along with long-term care. There are many different ways to structure these policies. Still, they generally allow the people to draw down the life insurance or annuity benefit to pay for long-term care costs while they're still alive. These policies can give some peace of mind that long-term care needs will be met while providing a death benefit if the long-term care benefits are not used or if the benefits do not exceed the policy's death benefit. Can be leveraged to pay for long-term care costs. Look at some of them. Equity in your home. One option for homeowners is to take a reverse mortgage. These allow homeowners to draw against the equity in their house to pay long-term care costs. The downside of a reverse mortgage is that you are potentially using up the equity in your home. One option for homeowners is to take a reverse mortgage. These allow homeowners to draw against the equity in their homes to pay for long-term care costs. One downside of these reverse mortgages is that you potentially are using up the equity in your home, but they usually include benefits such as tax benefits, as the loan proceeds are generally not taxed. When the home is sold to repay the mortgage, if the sale proceeds are less than the mortgage company has to take the loss. It usually means the homeowner cannot pass their home on to their heirs. Another way to use the equity in your home to pay for long-term care is by setting up a HELOC, home equity line of credit. HELOC allow homeowners to draw against the line of credit when the funds are needed. Often, there are minimal annual fees to maintain this line, and no interest is paid if no draws are made. HELOCs have different structures, with interest only or principal and interest payment options during the draw period, and various draw and repayment terms. Cashing in on existing life insurance policies for living benefits is an option. Selling a life insurance policy to a life settlement company for a percentage of the death benefit is one option for funding long-term care. The percentage received depends on one's age and health status. Many life insurance policies offer accelerated benefits to pay for care for those who are terminally ill. You could use pre-tax savings like an IRA to purchase long-term care protection. Retirement assets can be surprisingly substantial and a good source for long-term care needs. Using a Roth IRA conversion of a portion of a traditional IRA for backdoor Roth IRA contribution for those who make too much to receive the tax benefit for Roth contributions can help create funds to pay for long-term care, as Roth IRAs can grow tax-free and are not subject to required minimum distributions. Of course, consult with tax professionals. Long-term and disciplined funding and use of a health savings account is another way to help pay for long-term care, as both the costs themselves and the long-term care insurance premiums can be qualified health expenses. There are challenges and drawbacks to each of these strategies. Further discussion would be a part of creating a plan for paying for long-term care. What about simply self-funding? Should you self-fund? Are you relatively young and healthy? While self-funding is always an option, one school of thought suggests that investments are not a substitute for insurance, and insurance is not a substitute for investments. While it may make sense for some people, it does not for others. There are the additional challenges of self-funding, which include not knowing when you will need the care or for how long. The school of thought that says investments should be investments and insurance should be insurance also says that you invest well to ensure financial independence. You also insure well to protect financial independence. As I mentioned earlier, these new long-term care options are as varied as those who need them. Which factors determine which is the right one? There are many, but they include your age, marital status, your health, the health of your spouse or partner, your military service, as some veterans may be eligible for long-term care assistance, where you currently live and where you intend to retire, your family's health history, your total assets and wealth outlook, other financial and retirement planning that's been done, in your legacy and estate plans. While some may feel they are too young to think about long-term care planning, some options are best started when you are young and healthy. Others may think they're too old or ill to make up for the lack of planning. But in fact, there are options for people in this situation and all situations in between. Overall, here are some questions you'll want to keep in mind as you consider your long-term care plan. Who will provide the care? Where do you want the care? How will you pay for the care? It's also essential that you keep in mind a few other things. Your situation is unique, and there's no cookie-cutter solution for everyone. You can receive care in your home whether you pay for it, policy pays for it, or some other strategy. Having a plan is essential. It doesn't mean the plan has to cover all the costs. We're getting close to the finish, so let's begin to wrap up. We started with a problem. When it comes to a safe and secure retirement, planning for long-term care remains a confusing and unaddressed challenge for many people. Then we discussed the 4 keys to gaining financial security through planning for long-term care. Key 1 was that long-term care isn't about an adult sitting alone in a nursing home. It's a range of services designed to help people with health and personal care needs. Key 2, counting on Medicare or Medicaid is not a plan. Most people want to rely on it for long-term care, and many of you aren't eligible anyway. Key 3, given the historic problems with long-term care insurance, it's understandable people have avoided making a plan. And Key 4, new approaches to planning for long-term care, people's skepticism, and provide a wide range of flexible options for people at all stages of financial planning and health. So this brings us to our natural conclusion, the solution to our original challenge. And here it is. To feel safe and secure about your retirement plan, you need a custom approach, a real plan for how you'll pay for long-term care. We've seen a variety of approaches to this challenge, and I'd like to invite you to a one-on-one meeting to discuss what options you'd like to consider as you plan for long-term. Developing a custom strategy for how you'll pay for long-term care is an innovative and responsible approach to planning your retirement financial security. How can you get a real plan, one that's customized for your unique needs? As I mentioned during the introduction, I always invite people to come in for a no-charge long-term care planning overview meeting. In our meeting, we'll review your long-term care planning options. This is a chance for us to discuss your situation and answer any specific questions you might have about long-term care planning. Again, this is not a sales pitch. The conference's goal is to help you start formulating a plan. So come on in, talk with me. As a financial professional, I can use my planning experience to help you with your long-term care plans so you feel secure that you've got the right plan. You can click the link in the description to set up a time for us to chat on my calendar. Thank you all for coming. I hope this was beneficial for you, and join us again in our next webinar. And don't forget the disclosures.